All right, good morning. Let's go ahead and begin here. We've got some good stuff coming up in the near future, both a homework assignment and an exam during our next class meeting on Tuesday. So we're going to go over a few brief exam review concept ideas today. Broadly speaking, the coverage of the exam is just going to be everything from Class 1, including Class 10, which is today's material. So you'll notice that as far as the textbook goes, we are finishing up with Chapter 5 and also covering Chapter 6 in today's class. And so all that material will be included in the exam. All right, so on the subject of the exam, you're going to have both concept questions and problem-solving questions. And I wanted to give you an idea of what those concept questions could potentially look like. So think to yourself, would you be able to answer this question? What is the purpose of present worth analysis? And so what I'm looking for in a short answer question, the space that's available can be thought of as an indication of the level of detail I'm hoping to see. It's usually just maybe 3 or 4 sentences would be plenty. In this case, it's a pretty straightforward idea. The purpose of present worth analysis is to choose from among alternatives. Actually, you could say that that's the purpose of this whole class, is economic decision making, trying to find which alternative is better. Now, in the case of present worth analysis, the fact that you're doing it means that the two cash flow diagrams have different amounts in different years. And so you can say that the purpose of present worth analysis is to compare alternatives that have dissimilar cash flows. So you're taking all of the amounts to the present to find out which one is the optimal solution. So that's just an example of one kind of concept question you might see. What about this? We talked in class last Tuesday, just our most recent class meeting, about the LCM approach. By the way, what does LCM stand for? Least common multiple. Good, least common multiple. So what's the assumption that's built in when you use that approach?
You can make the purchase at the same price in the future. Very
good, yes. So he said the assumption is that you can make your purchase at the same price in the future, and also that the revenues you're going to receive will be the same in the future because you're repeating the cash flow diagram. So you're assuming that that's possible. Any questions so far? Usually on the exams, I aim to have about 35% of the points be related to concept questions, 65% of the points related to problem solving. So you have to be able to do both. Okay, here's another acronym, MAR. Last time I mentioned the MAR, there wasn't the quick and ready response that I was expecting. So who remembers what MAR is?
Minimal acceptable rate of return.
Good. Yeah, minimum acceptable rate of return. And so there's a lot of things that go into influencing what an organization selects as the MAR. It can be, first and foremost, borrowing costs. You would never set the MAR below your borrowing costs. But then it also can be related to the number of projects available. It can be related to the type of organization, meaning whether it's a public entity or a private company. Generally, private companies are seeking higher MARs than like a nonprofit organization, or employee-owned companies sometimes have other motivations than just maximizing profit. So go back through your notes because we spent several slides talking about selection of the MAR and what it can mean. Finally, remember when we were talking about effective versus nominal interest rate? Why is there sometimes a difference between nominal and effective interest rate? Now, first of all, this word sometimes is significant because there's not always a difference between nominal and effective interest rate. When are the two the same?
The interest rate's collected annually.
Very good. Right. So if it's annual compounding, then the nominal annual interest rate and the effective annual interest rate will be the same, because the two differ primarily due to compounding. And so remember, the effective interest rate is a big difference from the nominal when either you have a frequent compounding or at the high end of the spectrum. You know, you see the big difference once you get into the 20s for the interest rates. So any questions related to these? All right, one other hint for the upcoming exam. I like to show diagrams or pictures and ask you to explain, you know, what's the concept behind this diagram. So go back through your notes as a study technique and look at any sort of diagrams we've had in class. You know, cash flow diagrams, obviously, but there are other important figures that illustrate concepts. And so I may just show a picture and say, what is illustrated here? You know, what's the concept? Or explain this figure. So you've got all of the notes and the handouts. You've got the in-class exercise that I've given you. You've got the textbook. So there's a lot of good resources that you can use as you prepare for the exam. And of course, all of the lecture videos are also posted online. So if there was a class that you missed, or if there's an in-class exercise that you wouldn't be able to just sit down and immediately do without any trouble, and that's how fluent with this material you need to be for the exam, is you should be able to solve an in-class exercise or the homework without any trouble. It should immediately be obvious to you as soon as you see the problem, what kind of problem it is, and what's the route to complete it. So if you're not at that level on any one of the particular concepts, I'd suggest maybe flipping through the lecture videos again. All right, so we'll do that exam in class next time. But we have some new material to cover. So let's just refresh our memory where we were last time. Last time what we had was cash flow diagrams that were the different number of years. Remember, we had one cash flow diagram that was 6 years long, another one that was 9 years long, and so we used the LCM approach to repeat them until they both terminated at the same year. And so that's what this illustration is showing, is that we use the repeatability assumption so that in the end they both were 18 years long. What are the two mistakes that students often make when they're applying the LCM approach?
Skip a year.
So yeah, one of the two common mistakes is that when they begin the cycle again, they would purchase the item after a gap year. Remember, you want continuous revenue. So don't start the cycle, in this case, I know it's hard to see, but hopefully you remember it from last time. If you started the cycle in year 7 by purchasing the item in year 7 instead of year 6, then that would give you a gap in revenue. So don't make that mistake. What about the other common mistake? Right. Yeah, you don't need to buy it again at the end. I mean, it looks like you do because, you know, there's a pattern. Purchase, purchase, purchase. It kind of feels like there's an empty space here. Seems like, oh, maybe I should purchase it again. But if you did, you just bought equipment at the end of the project for no reason. So then that would mean you should repeat the cycle again, and they wouldn't match up. So don't buy the item in the final year. Okay. Another of our approaches to solving this problem of different time frames, that's the underlying problem here, is that two options last a different amount of time. So the other alternative is to make the one that's too short, make it longer through leasing an item, contract services, renting, whatever you need to do to just temporarily continue the other option until they're both the same amount of years. So that's the second approach, was make the short one longer. Who can remember what's the third and final approach? Yeah?
Early termination.
Exactly right. Early termination. So early termination is saying, all right, one of these is too long. Let's make the long one shorter by just selling the equipment early. So instead of wearing it out to the very end until it can't be used anymore, just sell it on the market and get a salvage value. Okay, so that's what we did in present worth analysis to compare things that have a different useful life. Once we did these different techniques to make the cash flow diagrams the same number of years, then we took everything to the present. Do you remember I told you about the phrase decision criteria? Decision criteria is really important for you to include on your problem solving, whether it's homework, quiz, or exam. You need to state which one is better and why. Like, how did you make that choice? And so the decision criteria for present worth analysis is that you choose whichever of the options has the higher positive present worth. So if both of the options have a negative present worth, then that means that you're going to lose money on the project, and so you choose the do-nothing approach. But then if we have both option A and option B, and they both give us some revenue when we discount everything to the present, then you choose whichever one is highest. So that's the decision criteria. So on your exam, be sure and state at the end of the paper, after you tell me what the answer is, like, how did you choose? What was the criteria you used for making your decision?
So on the homework, I had noticed that some of the questions, like, you ended up having like negative values at the end.
Mm-hmm.
Should you just done like do nothing approach?
Well, if both of them are negative, then you have to look at the
least one?
well, you have to look at the way the problem is set up. Sometimes the problems say that you have to buy a certain piece of equipment, and so then you'd be forced into buying whichever is least negative. But you can sometimes get clues whether do nothing is on the table from the way the problem is described. So it depends is the answer. All right, so we talked about present worth analysis. Now let's discuss future worth analysis. It's essentially the same thing, except that instead of taking all of the amounts to year 0, we take all of the amounts to some common future year for both cash flow diagrams. Now, why would you ever do that? There are some situations where you have a really long, big project that's going to take a lot of years to construct. And so in situations like that, it may not make sense to discount all of the amounts to year 0 when the project is beginning, because the payments that are actually coming out of your organization's budget, so many of them are in the future. And so it can make more sense to aggregate all of those expenses to some future year rather than to year 0. So that's one of the reasons. The other is if the project is going to be sold, then you may want to know what's the value of the project in that year of sale. So maybe it's a business opportunity that you're evaluating, and you want to see what's the overall value in a certain year. When you take all of the costs and all of the revenues into account, what would be the required selling price in some future year? So you do future analysis in either of those cases. All right, so I've got an in-class exercise for you to practice future worth analysis, and we're going to do this one with Excel. I see lots of computers today. That's good. If you don't have a computer, then my suggestion is you could try and get the Excel app on your phone. I mean, I really would prefer that you have a computer than trying to do it on such a tiny screen as a phone. But that would be one option, or just sit next to a friend who has a computer. Okay, so we have two different options here. They've got different time frames. So the first thing that you're going to need to do is make them the same length. And I tell you in the problem statement to use the least common multiple approach to do that. So you can do a sketch on the cash flow diagram just to make sure that they both terminate at the right time. And then what I'd like you to do is set it up on Excel. So the columns that you should set in Excel, you're going to need a column that says time or year. I guess let's call it year. And then you're going to have a column that's amount. And then we'll have a column that says future value of amount. And then at the bottom you're going to have the sum of all of the future values. Now, there's one other thing that would make it useful. These are the required columns, but what would make it a little bit easier would be if we had a year column and then a secondary time column. Do you remember that trick where we had one time column and then another one that was reversed? Why did we have that secondary time column? What was the purpose of that? Yeah, it's because when we're taking things to the future, each row, the n, is going to be how many years it is until the end. And so just by looking at this cash flow diagram, what year are we going to take all of the amounts to? 9. We're going to take everything to year 9. And so we'll have years until year 9 as another secondary time column. All right. And of course, at the top, we're going to have a cell that defines our interest rate. All right, so how do we solve a future worth comparison? All right, we have the time. We have to have this alternate time column. We don't have to. We could have embedded an equation for n inside of the function that we're actually using, but I think it's easier to visualize this way. All right, these amounts. Why is it 190,000 in year 3 and year 6? Shouldn't it be negative 225?
You gotta add the 35.
Okay, right. So when we draw the cash flow diagram, in year 3, we're purchasing the item for 225 and we're receiving the revenue of 35. So it's the net cost in that year. So that's why the amount in year 3 and the amount in year 6 is different from the amount in year 0, because in year 0 we had no revenue. And just to review some of the common mistakes that it's easy to get tripped up on, let's go into this future worth formula here. So you got to remember to anchor your reference to the interest rate, because if you don't and then drag the formula down, it'll be looking in the wrong spot for the interest rate. So put in those dollar signs. Okay, NPER means the number of periods, and that needs to be on our alternate time column, because we want to tell it how many years into the future is this 220 million going. So if it's going from year 0 all the way from 0 to year 9, that's 9 years. So it shouldn't be looking at 0, because that's not how many years it needs to move. So be sure and use the right time column. Now we have this double comma here because we need to skip over the payment field. Let's just say that we didn't skip over that payment field. What would it have thought? Like if we fail to put in that comma, we're going to get a wildly wrong amount, because what it thinks is it thinks that there's 9 years of payments of 220 million. So it's going to take 9 $220 million payments into the future. But that's not what we want. We want a single 220 million payment. So that's why we're not putting this amount into the payment field, because it's not a recurring payment. It's just a single amount for that year. So the double comma is important, and then the negative sign, just because Excel by default assumes that anytime you're using these functions, you have the change in sign because it's a payment/withdrawal situation. But in this case, we want to preserve the original direction, so we have to override that assumption that Excel makes and put in the negative sign directly. All right. So we have our calculations, and then the answer isn't, we're not finished. The problem isn't complete until we state which alternative is better and what's our decision criteria. So both of them are negative. If this was optional, then don't do either. But it's probably not optional. The port has to stay open. This dredging operation is required. So if it's a must-do, then option B is better because it's less expensive than option A. Okay. Any questions about that first in-class exercise problem? That's future worth analysis. You can do, so we just did future worth with LCM. You can do future worth with contract services, with early termination. You know, those 3 tools are just what you use to make the cash flow diagrams the same number of years. And then once they're the same number of years, then you can apply either present worth or future worth analysis. So there's any number of combinations there. Okay, let's try another future worth problem. On the next page, your uncle, the investor, is trying to compare 2 options. One option, if he pays $250,000 today, then he receives $33,000 a year for 11 years. So that's one alternative. The option, he knows that he'll get $25,000 each year, but he hasn't got a price from the seller. So he's trying to figure out, ultimately, how much is it worth paying for option B so that they are equal. So step by step, I ask you first of all to draw the cash flow diagrams for both of these alternatives, and then find the future value of option A, and then here part C is maybe the trickiest part. And I tell you specifically with this hint, what you should do is use goal seek and keep doing an iteration over and over with option B on some hypothetical purchase price until both of the future values are the same. And then that will tell you the maximum purchase price your uncle should be willing to pay for option B. So if the seller is offering the alternative for less than that, then option B would be better. If the seller is trying to ask for more, then option A would be better. All right, so same thing as before. It's always good to start with a cash flow diagram just so you can visualize the two alternatives. Getting closer. Getting closer. Closer.
Then don't even worry about it.
Okay, so let's just review what happened on this in-class exercise. So we're comparing two business opportunities. Option A and option B. Now it says that your uncle's MAR is 4.5%. So that could be maybe what your uncle is paying the bank to borrow this money. And the question is, do these business opportunities return enough to cover the cost of the loan and then also have some profits left over? If this is positive, then that means yes, there are additional profits above and beyond what has to be given to the bank to cover interest. If it's negative, then that means no, there isn't enough profit in this business to cover the cost of the MAR. So here, option A, we're going to compound each of these amounts into the future. Remember, anytime we're moving money into the future, we call that compounding. If we're moving it backwards in time, that's discounting because of how inflation works. And so here, the amounts get closer to their future amounts the closer you get to year 11. So you'll notice that $33,000 in year 10 is pretty close to $33,000 because it's only going to be compounding, moving 1 year into the future. Yeah, compounding 1 year into the future. So $33,000 in year 10, by the time it gets to year 11, is worth $34,485. Whereas that same $33,000, if you receive it in year 1, it has a lot of years to accumulate interest before it finally gets to year 11. So that's why these amounts are different as you move through time. All right, so comparing option A and option B, what we have to do is guess a value for option B because the seller didn't say how much it was going to cost. And so what your uncle is wondering is, when that seller comes back with the proposed cost for option B, what price would make the two alternatives the same? And so we just have to guess a bunch of values until the two future amounts are equal. And we can type that in manually and iterate, but it's a lot easier to go through the goal seek that we just saw on the screen there. And so the final answer is that your uncle should pay $181,768 for option B to have the same value as option A. And if your uncle pays that, then that means he can cover the loan and then still have the equivalent of $51,000 of profit in terms of year 11 amounts. We could discount that profit to the present and find out how much it's worth in today's terms. We could do that, but that's not what the problem asked. So if the seller of option B comes back with a price of less than $181,000, then option B is better. But let's say the seller says, I want $200,000 for option B. So if the seller wants $200,000 for option B, then option A is way better. But if the seller says, I want $170,000 for option B, then option B is a better alternative. So we've set it up for the break-even point between the two choices, and then we can kind of interpret that to know which way your uncle should go to invest the money. Any questions on that one? By the way, it's always a good habit to save your work, so I'm going to do that. That way you can come back to it when you're working on the homework assignment. Just have it available as a reference. What you cannot do during an exam is use a pre-existing file. During the exam, you have to just start with a blank workbook. And I'll remind you that on Tuesday when we have our test.
So there won't be Excel problems, but we can use Excel?
Oh, I'm sorry. Yeah, on Tuesday, this first exam, there's no Excel. So you don't need to bring your computer. It's the second exam, there will be Excel problems. So you cannot use Excel on this coming exam. Thanks for asking that. I'm glad you asked. Okay, well, let's talk about annual worth analysis now. Annual worth analysis, essentially what we're doing is we're taking some sort of a cash flow diagram where there's amounts in various years. You know, we've got amount in year 0, some salvage value at the end. We may have some sort of a refurbishment cost and then these annual expenses, and we combine them all together. You want to know what's the equivalent annual cost of a certain piece of equipment. That's annual worth analysis. And it's actually a nice way to do comparisons for alternatives because you don't have to bother making the cash flow diagrams the same number of years. It's already implied when you do annual worth analysis. So there's no need to use LCM or contract services or early termination. If you're comparing alternatives according to annual worth analysis, it automatically assumes that you've done LCM. So you only have to do the calculations for a single life cycle. It's already assuming that the equipment is needed for at least the LCM of the two alternatives. So if you've got option A, which is 3 years, and option B, which is 4, if you compare them according to annual worth, it's assuming that you're going to repeat those cycles for 12 years in total. And it also assumes that the amounts will be the same in each cycle. Now here's a specialized case of annual worth analysis. And I mention this because it's going to come up in one of your homework problems. What if an option continued indefinitely, forever? So you've got year 1, 2, 3, 4, and so on, but actually there's infinity of them. So what if you were to receive $50,000 a year for infinity number of years? How much is that worth in today's terms? I like the sound of that, by the way. I'd love to get $50,000 a year forever. But the thing is, by the time when you're getting really old, that $50,000 would probably be enough to buy a tank of gas. It wouldn't go as far as it's going today. So the way that you would find the present value of an annual series that continues on forever is you divide it by the interest rate. So what A is essentially the interest on whatever present value you pay. So let's just do that illustration. If we have an annual payment that we're receiving of $50,000, and we are in an environment with 10% interest, then the present value of that perpetual payment is going to be 50,000 divided by 0.10. So it's essentially the same as receiving $500,000 now. Have you ever heard when people win the lottery, they have to make a choice? What's the choice that lottery winners have to make?
Cash or payout over 30 years.
Right. They got to either take the lump sum now, or are they going to receive the amounts over 30 years? And so, when they say that the jackpot, the lottery is worth $100 million, it's not really worth $100 million today. What they're saying is that for 30 years they give you an equal amount, and if you add up all of those amounts, then the dollars they gave you was $100 million. But the present worth of all of those payments is actually going to be much lower. So this is how you can find the present worth of something that continues on forever. It's just a simple approach where it's A divided by I. So remember that for the homework assignment because there's a case where it comes up. A lot of projects that are public works types projects like bridges or roads have a very long time frame. Here's a picture of the Brooklyn Bridge in New York, and it's an old bridge, but it's been there a long time and it's going to be there for a lot longer, and so it continues to add value to society, perhaps indefinitely. So here's a cash flow diagram that says when you have the cost of construction in year 0, what if you wanted to find out what's the annual equivalent of that? So if it continues on forever, then how much would you have to pay each year to cover the cost of that original investment? Well, we just rearranged that same formula that we were just looking at. So on the last slide we said that P is A divided by I. What this is saying is you can find the annual equivalent of that first cost by just multiplying the first cost by whatever the interest rate is. Sometimes bonds are used to pay for big public projects like this, and they may, a government that doesn't have the money to build an enormous bridge, they may take a loan out, and everyone who buys a bond will continue to get regular payments to cover the cost of their original investment. And this would tell you what the annual equivalent is that would have to be raised to cover the cost of those bonds. Capital recovery is a special case of an annual series where what you want to do is find the difference between the original purchase price and the salvage value you'll receive when you dispose of the item. So if you're going to buy something in year 0 and then eventually sell it, maybe for scrap, maybe it's not quite scrap, maybe it will still have some useful life, but you're selling it at the end of its study period. Capital recovery asks, what's the difference between the two? What's the difference between the original purchase price and the salvage value expressed in terms of an annual amount? And the reason why you'd need to know this is, let's say that your business is that you're going to have a food truck. And so you have to buy the food truck and all the equipment in year 0, and then you figure maybe this food truck's going to last 7 years and you'll scrap it. And you'll get some minimal payment at the end for its salvage. What capital recovery tells you is how much do you have to make each year just to cover the cost of that equipment, considering the difference between the original purchase price and the ultimate disposal value. So the capital recovery doesn't take into account consumables like food. It wouldn't take into account labor costs. It doesn't take into account the amount you're spending on propane for the stove. All it is about is that equipment, the capital. The capital that you originally had to pay to buy the equipment initially. And so this is a phrase that you'll have to be acquainted with a couple of times in the homework and the in-class exercises. We're going to consider capital recovery. So from a formula standpoint, here's how you find capital recovery. You've got a present value that you want to take to an A. So you're going to do find A given P with the present value. So you use the interest rate and the N, find that factor either in the table or you can calculate it with the formulas. So you find A given P and multiply that factor by the present value. And then the salvage value at the end of the cash flow diagram, that is a future amount. And you want to find an annual equivalent of it, so you do A/F. And whatever that factor is, multiply it by the salvage value. One last note is, notice that we have a minus sign for the P and a positive sign for the S. Now, why is that? Why the difference in sign?
The P is a cost.
P is a cost. Salvage value is a revenue. So the overall capital recovery takes into account that one of them is money coming to you, the other is outflow. We want to know the net difference on an annual basis. Okay, now this is a good time for me to give you a hint on the homework. Problem 611 is one of the homework problems that you're asked to solve. And so let me pause for a moment and let you read this problem statement. If you haven't already started on that assignment, read the problem statement, then I'm going to help you interpret this. Could you draw a cash flow diagram for this problem? That's the first thing you should always think about when you've got some wordy problem like this. We're not English majors, we're engineers, right? We want to see a diagram, not read a paragraph. So translate the paragraph into a diagram is my suggestion. And so what it's saying is that there's going to be this person is getting some money for an inheritance, and they're taking the money and they're spending it. So in year 0, they're spending $500,000. So there's an expense. P is $500,000. And then we're talking about, what is it, a 20-year time frame? So 1, 2, 3, 4, 5, 6, and so on and so forth until we get to year 20. And then she's going to sell it at 90% of the original purchase price. And so that future value is 0.90 times 500,000. And it's asking, what is the capital recovery? So it's saying, convert that cash flow diagram to an equivalent annual amount. A equals what? And she wants to make 8% per year, so I equals 0.08. So what you need to do is you need to find the 8% factor. N equals 20. Find the present value, multiply it by the A/P factor, so that'll find the annual equivalent of a present amount. You find that factor for A/F, multiply it by the salvage value, that's the sales price in year 20. And then capital recovery is the net difference between the two. So that's how you do part A. Part B is what throws students off. And so in part B, I'll give you a moment to read that. Okay, so part B is saying we're going to compare two alternatives. What if this person wanted to sell in year 10 instead of selling in year 20? So how much would the purchase price, well, how much would the sales price need to be in year 10? So now we're in year 10. F equals what to still get 8%? So use the same capital recovery amount that you calculated in part A, which means she buys the condo for $500,000 in year 0. She gets the income in 10 years. She's going to get this capital recovery amount that you calculated in part A. And so if she sells the condo in year 10, then what amount would make sure that she gets 8%? And so this is a lot like the uncle problem that we just solved. That's kind of why I created that in-class exercise, is so that you'd be ready for this homework problem. What you're going to do is you're going to have to keep playing around with this future value, and you want the overall sum to be the same as it was in part A. So I don't want to give you too many additional hints beyond that, but hopefully that breakdown, the real hint is that in part B you continue to assume the same capital recovery from part A. So capital recovery basically means how much does she need to get from the renters each year to cover the difference. So in part A, when you calculated that capital recovery, that's what she'll be pocketing in order to realize the 8% return. All right, so let's practice annual worth analysis. We've got some time to do this one. Problem 3 on the handout I gave you is that we have the cash flow diagram that's given on the left. It's a transmitter of some sort, and we want to know what would be the annual equivalent if we were going to convert it from this series of individual amounts and an annual series and a salvage. What if we just wanted to find the annual equivalent? You're going to do this one by hand rather than by using Excel. So on the back side of the paper is the 8% table. So my suggestion is part A, first of all, remember how we sometimes break things up into steps and you're methodical about it? You don't just start writing the factor numbers in. You say step 1, I'll move here, this amount in whatever year it's in, and kind of outline and show me the evidence so that if you make a mistake, I can give you partial credit because at least your solution strategy was correct. You've got the test coming up, and if you make a mistake, I want to give you as much partial credit as I can, but if you're just immediately starting to write factor table numbers, then you're not really giving me much to work with. But if you outline your solution strategy, and you show step by step, you show that it's an A/P, and what is the I value, what is the N. If you show your intermediate work steps, then it's easy for me to give you lots of partial credit. All right, so I'm going to stop talking here, give you some time to work through this one to find the equivalent annual worth.